Shopify is up 73% year to date, but I want to show you guys how insane the stock has been. It's currently at $62 a share. The all-time high was November of 21 at 176. Guys, less than a year later, it was $24 per share. It's up almost triple since October of 2022, Mo. This has been a highly volatile stock.
Yeah.
It's a $78 billion market cap. That means if you bought every share outstanding, you have to pay $78 billion. But look at the enterprise value here, Mo. $76 billion. This means it's the market cap plus all debt, less any cash. So it's actually have more cash on hand than debt. So it's hard for companies like this to go out of business. But the question becomes, is this a reasonable price? Is $67 a share a reasonable price for the company? Guys, we're going to go over a lot here in this company. We're going to go over some financials, some fundamentals, our 8-pillar process. We're going to go over analyst estimates, and we're going to finish with the stock analyzer tool, which will tell us, based on our assumptions today, what price to pay for the company. We're also going to do some bull and bear cases. So stay the entire video because there's something here for beginners and there's something here for more advanced investors. Everybody here will be able to learn something. Mo, do you see this profit margin?
Yes.
So they're just losing money hand over fist.
Free cash flow as well. Not good.
Free cash flow, negative.
Yeah.
5-year free cash flow, 140.
Yeah.
Now, I will say they're trying to grow like crazy,
They
right?
are. Yep.
Let's look at their income statement. I mean, look at this growth. The growth is huge, guys. It did 18 million in revenue 10 years ago. Now they're doing 6 billion, but they're losing money like crazy. Why? Probably acquisition costs is my guess. Wow, they actually made 1.6 billion in the year of COVID. The 1 year after COVID, they made $1.6 billion.
They have a good product.
They do have a great product.
Yeah.
Absolutely. But guys, you're buying this company based on a lot of hope and prayer that things work out, right? So here's the interesting part. They're basically software driven and their gross margin is 48%. That means for every extra dollar they sell, they make 48 cents that can go to pay overhead and income taxes. A company like Microsoft is 68%.
Ooh.
Yeah. Palantir is like 80%. So it's quite different here. I'm actually surprised the gross margin is so low. Mo, can you go over some news and some bull and bear cases before we go further? Because I think that's what we need here. I'm sorry. Shopify's at $62 a share, not $67. Go ahead, Mo.
So this is an interesting one. The Canadian tax revenue officials, they want 6 years worth of data for Shopify user base.
Oh boy.
Oh boy is right. They say the tax man is coming. So
Taxman is coming.
That's an interesting one. Shopify offloads its logistics business to Flexport.
Who took the 13% equity?
Sold off its
Shopify
logistics
did?
division for a 13% equity stake in Flexport. I'm assuming that's PE, wouldn't you say?
What do you mean PE?
Like a private equity group?
Oh, I gotcha. They meant like price to earnings.
No,
Like, what?
sorry.
I don't know.
Yeah. You want to go into bull and bear cases?
Let's do it.
So they partnered with Google and Microsoft in 2021 to expand product offerings. That's a great move. In the latest earnings call, they grew gross merchandise volume by 15% to $49.6 billion in revenues by 25%.
So what they're saying there, guys, gross merchandise value is the merchandise that was coming through, the amount they charged for was $50 billion. That was an increase of 15% in transactions to their company that they get to charge fees on.
Yeah.
So what are their bear cases?
Bear cases. They charge high fees anywhere between 0.5 and 2% plus an additional fee for the membership you pay monthly. Do you or any of your businesses use this?
I don't know. I don't know if we do.
I have never met somebody that's used it.
I think it's for more small businesses.
I've just used it as a consumer. Competition from Amazon, Buy with Prime, allows merchants to use Amazon payment systems and infrastructure if they need it
For their own
websites, yeah.
Yeah, I mean, listen, when I go to a website and I'm offered ways to pay, my first default is PayPal. If they offer PayPal, I just go to PayPal. My second one is Amazon. Because
my first one is Apple Pay.
But to me, Apple Pay is just a way of charging.
Just a way of paying, yeah.
Yeah, but PayPal, I like the whole.
Shopify is also. I've used Shopify before. I've selected that option, yeah.
Okay. All right, well, let's go check out some things. Let's go check out the 8 pillars on Shopify. And guys, remember, if you have our software, you can customize your pillars up to 12 pillars and 4 quadrillion different variations or so. I got to get the exact number there because it's not 4 quadrillion. It's actually higher than that. Wow, look at this, Mo. All X's except for revenue. Guys, this is a company that's focused on growing.
Growth.
And look how they've grown also. They're issuing shares. Guys,
Yes.
when a company needs money, they can either borrow it through debt or issue shares, which is basically offering it through equity. The problem with this is, and this is the silent killer in investing that not many people pay attention to, is this dilutes you as an owner.
So over the last 10 quarters, they really haven't increased share. They've gone from 1.22 billion to 1.28.
Oh, okay.
They've definitely slowed down. I think the big share dilution came probably during COVID. Let's take a look.
No, actually earlier than that.
Pre-COVID,
as they were trying to grow like crazy.
Yeah, so they've slowed down. So that's good.
Oh, good boys.
But yeah, still.
Good job, guys. Way to stop screwing the existing investors.
Yeah.
But everything else is just ugly. Price to free cash flow, 563. So guys, the question you shouldn't buy or not buy a company based on these. These tell a story. The 8 pillars are here to tell a story. That's it. From the story, you have to go uncover certain things. So let's go and see what analysts are saying about the company.
Saying a lot.
They expect the company to make 5 cents a share this year and get up to $1.50 in 2027.
Pretty solid.
That's a lot of growth, guys. So at today's prices, it's still a 40 PE based on December 2027. That's a lot. That's a lot. All right, revenue growth. I'm sure this is going to be huge.
20%.
6.8 billion up to 15 billion in the next 5 years. That's a lot of growth. A lot of growth in revenue, guys. 20% a year. Does that take us to the stock analyzer tool?
Yeah.
So guys, we're going to use a stock analyzer tool. Remember, every investment is the present value of all future cash flow. And the more you pay for something today, the less return you're going to make. The less you pay for something, the more return you're going to make. But we don't know the future. So our goal is to make assumptions about the future. And that's what we're doing here in our stock analyzer tool. We're making revenue assumptions, profit margin, free cash flow, ending PE and free cash flow. And then what is our desired return? This is our margin of safety. Yeah. Now, if you like this and the software, everything we've done, and all these tools that are available, these are all available, everythingmoney.com, $7 for 7 days, $1 per day. And it includes a community of thousands of investors that you can chat with. Thousands of messages are exchanged every single day. Now, the benefit of our software right now is the real estate calculator is being developed. If you sign up now, you get this real estate calculator included. At the end of this month, it's going to go to its own separate tier. And whoever didn't sign up for that doesn't get grandfathered in. You have to buy it separately. So sign up. You get all these tools here, including the real estate calculator, for $7 for 7 days, $1 per day. So check it out. Now, Mo, we're going to do a 10-year analysis on Shopify. But the hard part here is we're going in blind because there isn't much profit margin to even, we literally don't know what the profit margin will be.
Right.
The free cash flow margin's been there over the last 10 years and 5 years, but we don't know overall profit margin. So Mo, let's start with 10-year analysis. You can do 1 to 20. But we're going to do 10. Well, give me some revenue growth numbers. Remember, the analysts were expecting 20%.
Yeah.
So over the next 5 years.
12, 18, and 24.
I like that. So remember, guys, he went lower than 20 because that was a 5-year estimation on analysts.
And their analysts.
All right, what about profit margin, Mo?
Oh, boy.
So 48% gross margin. What do you think a profit margin would be? So this is what we don't have their history to know. We have to make estimates here.
10, 14, and 18?
So I'm going to go 10. How about 16 and 22?
Okay.
Because if you have a 48% gross margin,
you can get to 22.
Yeah, I think so.
Yeah.
All right, free cash flow margin.
What are you going to do with this?
I'm going to keep it exactly the same as profit margin.
Okay.
Exactly the same. Even though their free cash flow has been higher, I think it's just based on how they operate the business. I don't think it's going to overall be higher in long periods of time. Okay. Now, what about a PE, Mo? Since we always start at 15, that's the market average. We go up based on revenue growth assumptions and ROIC, the return on invested capital. Can they reinvest back in the business at high rates of return? And then we go lower if these things are lower. So they obviously have a lot of growth potential.
16, 19, 22.
I'm fine with that.
I mean, if they could do 24% revenue with 22% margins, you said?
Yeah, and guys, these are all, we're guessing here. This is the reason why we have low, middle, and high.
These types of companies are very difficult.
They're very, very difficult. Extremely difficult. You're going to have a very wide range at the very end. Now, desired return. Guys, this is your margin of safety. The lower the assumptions, the lower return you need. The higher the assumptions, the higher return you need because it's more margin of safety. I think in and of itself, this company needs if the market average is 9 or 10%, you can invest in the ETF. I think even on the low side, you need a higher return than that. So what do you want, Mo?
15.
Wow, on the low side?
Yeah.
Wow, okay.
I mean, I look at this as if I was investing in this company, I would really want to have some margin of safety in there.
Okay,
17 and a half and 20.
Okay, so guys, again, you're probably thinking that's too high, but guess what? Mo, I think 15 is too high. You know why? They have more cash on hand than debt. So I don't think they're going out of business, and they are very good with users.
12, 15, and 18?
Why don't we do 13, 16, and 19? Because I don't think you should invest in Shopify unless you're going to get at least a 13% return on low numbers. I think to myself, I'd much rather buy a good staple company that has a decent dividend and is paying down debt and buying back shares.
Yeah.
So guys, we're gonna hit the analyze button. And by the way, guys, I want you to remember, this is the kind of conversations we have because we're not gonna agree on everything. We're not, and you're not gonna agree with everybody else. The whole goal here is to learn a process and be confident in that. Now, I'm gonna spend the next minute going through these numbers. Stay with these numbers. This is about teaching a process. And I will explain these numbers thoroughly. We have a low price of 10, a high price of 45, and a middle price of 24. If you pay today's price of $62 and the low numbers occur, you're gonna lose 7.5% a year. If you pay today's price and the middle numbers occur, you're gonna make 4%. If you pay today's price and the highest of high occurs, you're gonna make 14.7%. My question to you is, are you comfortable with the highest of our assumptions happening and making 14.7%? Are you comfortable with the lowest of our assumptions happening and you lose 7.5%? Guys, this is the power of our tools here. Everythingmoney.com, $7 for 7 days. Go sign up, go check it out. You will be very glad you did. Thank you very much for your time.